Hello, I'm David Cassidy with the market summary for the week ending Friday, the 5th of February. Unfortunately, you can't always get what you want, but thankfully, we did get the next best thing from the Bank of England's monetary policy meeting last week. Negative UK interest rates are viable, and if the economic outlook weakens, then the Bank of England is ready to take action. Now, while we weren't expecting any immediate policy changes, we had hoped that some of the 9 policymakers would have voted for negative interest rates now, but unfortunately, it was a unanimous 9-0 vote to leave interest rates unchanged. Interestingly, by stressing that negative interest rates are viable but not imminent, policymakers have been very clever as they are effectively keeping their options open. In other words, they want the flexibility to move into negative territory if economic conditions deteriorate, but at the same time, they aren't spooking the markets into pricing tighter monetary policy by ruling out negative interest rates, but instead saying they have little appetite for them at present. As for the economic outlook, the Bank of England reduced its 2021 GDP forecast from 7.25% to 5%, as they now expect that the economy will shrink by 4.2% this first quarter due to the current lockdown restrictions. However, as they still expect the economy to return to its pre-coronavirus size during the early part of 2022, this obviously means they are expecting economic growth to recover much quicker once the lockdowns are lifted than they previously forecast, which is no doubt helped by the rapid coronavirus vaccine rollout in the UK. Bizarrely, the market was taken aback by the Bank of England's inflation forecast, as policymakers now expect inflation will accelerate sharply towards the 2% target. Now, this should not have come as a surprise, nor should it be a concern. Inflation is always calculated and expressed as a percentage change compared to prices 12 months ago. And thanks to a mixture of OPEC supply cuts and a more optimistic economic outlook, the oil price has risen very strongly over the past 3 months and is now roughly back to its pre-coronavirus level of around $60 a barrel. As a consequence, over the next 12 months, the oil price is likely to be significantly higher than it was on a rolling 12-month basis, especially come March and April this year, given the sharp collapse in oil prices we saw, remember, in March and April last year. However, we believe the Bank of England and all the other major central banks, for that matter, will ignore this inflation, as it is simply the pass-through of a distorted oil price rather than inflation caused by excess demand. As we said last March and April in our market commentaries, it was just a shame that we all couldn't take full advantage of last year's oil price collapse and a sub £1 a litre petrol pump price given the lockdown restrictions. Elsewhere, as you can see from the accompanying table, the Italian equity market was this week's clear winner, ending the week 7% higher on speculation that Mario Draghi, the former president of the European Central Bank, will be the next Italian Prime Minister. In the US, while the unemployment rate dropped to 6.3%, its lowest rate since last March, disappointingly, employment came in lower than we hoped, as non-farm payrolls grew by just 49,000. However, at the expense of again appearing Pollyanna-ish, this disappointing data release is actually good news, as it highlights the need for more fiscal stimulus. For those interested in the US company GameStop, which we've discussed in our previous couple of market commentaries, the share prices, which touched $483 on Thursday the 28th of January, closed on Friday at just $63.77, a decline of 87%. Looking ahead this coming week, we have UK industrial and manufacturing production, UK quarter 4 gross domestic product, UK and Chinese CPI inflation, US weekly jobless claims and the University of Michigan Consumer Sentiment Index.